Hey everybody, it's Lawrence from financialthink.com. As always, the Thursday evening live stream, peer-to-peer lending, of course. This evening, Stuart Law, CEO of Assetz Capital, is going to be joining us. Put your questions in the comments if you have any questions that you want Stuart to tackle. I will present some to him. I can't promise we'll present them all, but yeah, glad everybody's here. We're going to get right to it, so this doesn't run too long. Just bear with me for a minute. I will bring him on here. 1 second. All right, Stuart, can you hear me okay? All right, 1 second. Hang on 1 second. Let me unmute you. There we go. There he is, the man himself, joining us from sunny Manchester.
Good evening or good afternoon for you.
From sunny Manchester, right?
It is actually. I don't know why. There was a heck of a storm here this morning.
Oh, really? So listen, Stuart, thank you for taking the time to do this. I know you're a busy man, and it's always a pleasure to have you come on here. It's been a little while, so I know.
No, it's always good to join you. Always good to have all your good questions and have a chance to speak to people.
We do. We have lots of questions. And for anybody that's watching in the future, this on catch up, you'll be able to give them lots of good information about Assetz and what you guys are up to future. So let's crack right into it. I think we talked maybe in 2021 and maybe even at the end of 2020. So it's been about, let's say, a year and a half. How's 2022 been for Assetz Capital so far? Has it been a profitable year?
Yes, yeah, well, 2022 for us is starting a few days ago. So April 1st is the first day of the new financial year anyway. But no, things are looking very good indeed. We have the best product range in terms of our borrowers. We've maintained interest rates on the investor side of things as well. And things are looking good for both sides of the balance sheet, as it were, even though we don't actually have a balance sheet as such. But if we were a bank, that's what we'd be saying.
Yeah, and when I say how are things for the year, I understand obviously the tax year runs April to April, but how have things been since the beginning of January 1st now versus say 2021?
Very busy indeed. The whole industry, the whole lending industry is mad busy. There's a huge amount of capital looking to lend, and that obviously carries risks potentially, but there are large numbers of businesses with perfectly viable, sensible propositions. Lots of people investing. We of course don't invest beyond the senior debt level, so if we're at say 65% loan to value, for example, what that's telling you is there's an awful lot of people willing to put in the equity, put in the risk capital ahead of our lending to go ahead with new projects, and the market is really, really busy.
That's good for you. So talk to me about investor returns for 2022 going forward to the end of the year. Do you think that these interest returns are going to remain relatively the same as what they have been, or maybe improve or decrease?
We've certainly got an interesting situation at the moment because we've got inflation, which is taking down the real returns of any kind of interest rate. Bank savings rates were already underwater versus inflation pretty much entirely. But equally with inflation, CPIH, which is Consumer Price Index including housing costs, that's up to about 5 point something percent now, about 5.5% now, and that's a bit more than our access accounts, but also a bit less than the gross interest on the manual lending account as well. But it's interesting that we're getting into the zone where our interest rates are similar to the sort of level of the inflation rate at the moment, and certainly the Bank of England's forecasting it's going to go up and up and up further in a bit of a spike. But if you look 2 years out on the Bank of England charts, they're currently forecasting inflation to be back to 2% or so. Do I think that's going to happen? I don't think it's very realistic, frankly, given what my view is of the world and what's going on. But I do think we are looking at a spike that will come back fairly hard at some point. but I cannot possibly see it going back to 2% as a whole, probably, mainly due to energy and other factors.
Yeah, everything has gotten very expensive. It seems to just be going higher and higher. Let's talk
So
about
that's the point, yeah, because
yeah.
to answer the other side of your question, that's inflation taking everybody's returns down in real terms because inflation's eating away at the return. But equally, can we put rates up? That's a question we sometimes get asked, and very difficult because of this wall of money looking for a return. If we put our borrower rates up, because we work on a very tight margin as a business, we operate on a sliver of income. It could be typically 0.5% to, in some cases, 1 point something percent margin on the loan. So what that means is if the interest rate to a borrower was, say, 6.5%, we might collect, say, 0.5%, 0.9% from that, and the balance goes to the investor. So for us to put rates up, it wouldn't benefit us. We'd still take the same margin, but it would just slow down demand and slow down loan origination. And also, when you raise rates, you move up the risk curve. So the better quality borrowers can get this wall of money at good pricing. And we're at sensible pricing for the type of loans that we do. So if we were to put rates up, we haven't got any flex in our margin because it's already very tight. So it would mean putting up the rates to borrowers. And that would necessarily involve moving up the risk curve a bit for our investors. And we don't think this is the time with all the things going on to be doing that, really. So covering people against rising inflation is our mission, but trying to exceed it in this world of a wall of money looking for a home would just take us way up the risk curve and isn't what we promised our investors.
Yeah. And we'll definitely talk about, what's going on with the sort of demand and supply within the Assetz accounts. I know a lot of people in the stream are asking questions about that, and we'll get to that. But
Yeah.
I saw in some numbers a couple of days ago that in March 2020 that your loan volume was about 13 million pounds. And you've kind of had this, this was off a third-party website, so I don't know if that's completely accurate, but
don't know. Yeah,
yeah.
It sounds quite low, but then we're quite a lumpy business because our average loans can be quite sizable. The current average loan size is around £2 million, for example. Mm-hmm. But even when the average was 700k, you have very lumpy months. Mm-hmm. You could find you're doing almost nothing under 1.5 million one month, and the next month almost everything's under $1 million.
Just kind of rains down.
But certainly pre-pandemic, we were originating around 25 to 30 million pound a month or so of retail loans, and we're certainly not doing that level at the moment, but we are rapidly growing that volume, and I've got some figures for you if you like them.
Yeah, absolutely. So let me ask you, going back to this loan volume, I know we've sort of had this long pause of where the manual lending account didn't really see any new loans for a while, and I'm imagining that now I'm seeing more of these new loans coming out on my email. I get the emails every few days saying a new loan's coming out. How have you seen the demand versus the supply between loan applications, and have you had to be more selective about what you approve going forward? Has there been a big amount of loan applications?
No, that isn't the language at all that we hear around the office at all. It's certainly a risk. It could have happened. But no, we see vast. I suppose it might be a function of our price point. We're not a platform that pays 10% to investors, for example, which takes you up that risk curve. And if anything, we've come down that curve. So we are not seeing those sorts of risky loans suddenly becoming the majority of the applications at all. And to be honest, it feels very much like, in many ways, it might sound weird, but it does sound very much like the benign conditions pre-pandemic. We're seeing plenty of difficult cases you wouldn't go anywhere near, but no different to normal. And no, we're not seeing any kind of pressure to do risky lending in that sense, because there are vast numbers of sensible loan opportunities out there. There are lots of people chasing them, but they haven't necessarily got the speed of service, the price point, the relationships, the track record, the list goes on. And so we win plenty of business.
So let's talk about, Stuart, the Assetz accounts. I logged in a couple of days ago. I saw everything on those had been paused, at least on I think it was the quick access account.
Yeah, it's been paused for quite a while in the past, but do you want me to go through the dynamics of what
Yeah, tell
happened?
me what's going on with that. Yeah, I'm sure everybody's going to be
Yeah,
interested.
I think we've explained it a few times, but there's more context that you can see around you, literally today, in the news of other people seeing similar types of effects in their businesses. And I guess we just saw things happening that we talked about earlier than many other industries. But I'll come back to ferries and airports and things shortly, because that's an example of just one of countless industries seeing log jams, supply chain issues, concertina effects as the market stopped in the pandemic and then started up. But can everything start up in the supply chain again? This is what I've explained a couple of times, and I'm very happy to go through it again, because you can see other industries seeing similar issues now. What we had was a perfectly good machine running pre-pandemic, 25, 30 million a month going out, 25, 30 million a month coming back in. Obviously, there was a bit of a difference because we were getting new money in as well. But loans redeeming, loans being funded, the accounts growing as well. All the numbers were just growing and adding up, and it was all relatively smooth. But then the pandemic hit, and about half of the accounts or so wanted to have their money back, and that's it's big numbers, because we had commitments to fund borrowers of something around 100 million or so cash coming up over the forthcoming year, and we had a lot of investors wanting to redeem their investments in loans faster than the loans repaid. So we effectively had a need to put 100 million or so out and a need to redeem, say, 100 million plus. So we had a net requirement for about £250 million of cash in the first worst year of the pandemic. So quite a lot of money, and you need to have a plan to deal with that. So we had to cease lending using retail cash to maximise the impact we could have on those requirements. And so we just ceased lending altogether for a short period before we moved into the institutionally funded C-bills. And we basically, within a period of time far faster than the loans repaying, dealt with that entire requirement of people to withdraw cash. So that all went out, but of course we'd stopped the machine originating loans by that point for the retail crowd. Well and truly stopped it, and moved over into what is a different nature of origination for C-bills. And then we were geared up for RLS, but of course by that point we'd just about finished paying all the investors off early who wanted to redeem early, and paid every penny of the money to borrowers who had loan commitments from us. So as I say, finding £250 million of cash in the middle of a pandemic without a fairy godmother is it's an interesting business model, and it worked. But it was a bit painful, but we absolutely had to stop lending. So now, once that was all dealt with, we had to restart the lending engine. And that takes time, because everybody's a bit distracted. They're focused on a different nature of origination, and it's just taken some time to get up and running. But if I give you some numbers, in January, we did about £8 million of new retail lending, for example. Stuttered a bit in February, a couple of million. March was about 9.5 million, and this month looks like about 17 million. So we're really getting back up, and we won't go back to 25, 30 million immediately, because not everybody who took their money out has put it all back in again yet. So the accounts overall size are lower than they were, but plenty of people put their money back in. But it has, as you commented on, it has ended up back in a queue, coming back in. And the reason for the queue, very, very simple if you think about it. You talk about interest rates, we've got rising inflation. If we'd have accepted the cash coming back into the platform after we'd stopped lending and paid it all out, that if that had gone back in the Access account straight away, the way the Access accounts operate is it would have diluted the returns. So we could have accepted the money back in and dropped the interest rates. But that isn't really what people are asking. And what does that say to the investors who say didn't leave, for example? So should we drop their interest rate to then bring back in the people who did leave? It's all very complicated. There's no perfect answer. So the answer we did went back to how the Access accounts worked at the beginning, when there was way more demand than we had loans. and we reinstated the queue. So the queue is there just to basically not load the Access accounts with excess cash, which would force us to drop interest rates. In a rising inflation world, and in those days it was the foothills of inflation growing, now it's much more sort of escalating. But even in those times, we didn't really want to be dropping rates in a scenario that we could see interest rates really should be going up, and inflation definitely was. So what we had to do was create the queue. First step was to use up the spare cash inside the Access accounts. So that looks like it'll be used up in entirety during part of this month. And then we'll start pulling money in from the queue. And then we'll go back to a normality. And a normality will be a relatively short wait in the queue. But once you're in, and you'll keep moving forwards if all things carry on as they are at the moment in normal market conditions. Then once you'll get your interest, and it's only new money that would have to wait for a period in order to then come in again, or if somebody takes the money away, it'll take a while to get it back in. Okay. So we're just basically getting back to normality, and it's a couple of years in, and you can see what's going on in supply chains all over the world, but much more visibly to many people going away for Easter. Look at the chaos of people trying to restart their business models. Look at airports who furloughed and then fired most of their staff. Manchester Airport, close to me, is frankly in a terrible mess. Terrible mess. I've been through it a couple of times in the last 6 months, and believe me, it's not in a good place for an international airport, and it's absolutely down to having lost all their people, trying to get them back in, lost all the knowledge, the skill, and it's that concertina effect. It isn't that easy to restart an engine, and that's the problem we've had. Restarting the retail engine on top of very hungry institutional investors who did fund through the pandemic, admittedly with the benefit of CBILS, it just takes time, unfortunately.
Yeah, and I know people can appreciate, what a complicated machine it is from the outside. All we can see is this, internal dashboard where we plump money in, but on the internal side, you're dealing with all of these difficulties that have come from a bowl of bat soup and have affected the world.
We just want to give people what it says on the tin.
Yeah.
It's not a promise with a capital P, because we don't provide guaranteed rates or any of those sorts of guarantees. But instead, if we say somebody is to expect something, if we've set out our stall and said we're going to try and do this and that and the other, we don't try and fail, we try and succeed. And so, there's a lot of detail goes on in the background so that the accounts appear nice and straightforward. And we take cautious approaches, we leave lots of slack in the system so that we give people a simple experience. So it does what it says on the tin, even though there's lots of disclaimers. We don't want to rely on disclaimers, sometimes we have to, but on the whole, you don't want to have to rely on those. You just want to do what it simply says. If you read a few words on the site and don't read the disclaimers, if you want to look at it very simply, then we feel that we have to do our very, very best to try to give the simplest experience to people and not bury them in detail and problems and difficulties and challenges. That's our job. That's what we're here to do.
That's the bank's jobs.
That's what any investment house, any institutional fund manager, any retail fund manager, anybody who's doing anything to do with investment, banks, they're all doing the same. Mm-hmm. Keep it simple, but having a simple business involves a lot of detail. It's not especially so simple. If it's going to deliver on what it says.
Not so simple. It
is busy.
Well, for anybody that is joining us, after the start, we've got Stuart Law here. He's the boss man over at Assetz Capital. So please hit that thumbs up. It helps with the algorithm of YouTube. You know the story. And we're going to press on through these questions. I know some people have got some questions in the stream, so I'm going to hit you with those at the end. Hopefully it won't make you sweat too much. Let's talk about, so the manual lending account. Again, I've been seeing these new loans kind of coming through. Do you expect the volume of manual lending offered loans to become more increased, say, through quarter 3 and 4 of 2022?
You'll see it starting right now, because as we're beginning to fill up the Access accounts again and grow them and reduce the queue, The natural flow is for us to release excess lending within the access accounts into the manual lending market. And that's the natural flow. It creates a steady flow of lending volume to those who want to pick manual loans. So that's how it all used to work. And as the access accounts restart, they're at the beginning of the pipeline. And the next step is to release stock into the manual lending account. So yeah, that will absolutely be happening. It's already been happening. That's why you're getting those alerts to a degree, but it'll be happening even more this month and an awful lot more going forwards.
So this is always a difficult one, but I've noticed in my own account in the manual lending from some of these older loans that a lot of them are under trading suspensions right now. And
Indeed.
I know people in the stream are asking me the same thing, like what's going on? Why are there so many loans that are suspended at the moment? Can you give us an uptake on that and what's being done to sort those out?
Yeah, there's two different factors. So one factor would be quite simply any loans that are having a little bit of slow speed being picked up in terms of repaying on time, etc., or any noise. Those would tend to be the loans more that were in the access accounts as we ran them down a bit. But actually, the real reason is the hair trigger approach. Suspension isn't default, and suspension isn't necessarily loss either, or even an expected loss. Suspension is about not necessarily knowing that we know for certain the answer, because under the FCA regulations, we have to permit fair pricing of a loan. And the second we get any kind of feedback that means we may not be certain of the current situation, then we're going to get into hair trigger, press of the button. Now, you can see that secondary markets do occasionally have challenges. I think there might be one this week, maybe. And the whole situation with secondary markets is there are some very, very detailed regulations from the FCA around how those secondary markets operate and price loans that you make available for trading. It gets worse if you automatically trade them, but it's critically important to not allow someone to trade in something that has something you're not certain you've given a good steer on the valuation on. And valuation in loans is a bit of a difficult thing because it's not quite as simple. We all understand the valuation of a property. It's quite a simple concept, isn't it? But valuation of a loan is a bit more difficult due to the nature of the wording of the FCA regs. So we did a lot of work on that some time ago, and we have our way of interpreting that, which is quite sensible and cautious. And it does mean you have to have a hair trigger approach to suspending loans. So suspending loans does not mean at all, there's no direct correlation to losing money. It doesn't mean the loan is going to be defaulted either. It just means we're just a little bit interested in the loan, more interested than normal. And there's other phrases we use internally called monitoring. Of course, we monitor every loan every month all the time, but monitoring means we go into a more proactive monitoring approach, and that can lead to suspensions. So it's about investor protection. Doesn't mean there's a problem, but it does mean you can't trade the loan. And that's necessary if you were to have trouble sleeping and want to read the regulations. It's very precise, very tight in terms of the rule sets, and necessarily so, to be honest. I think it's a good thing, because we've seen lots of examples where loans are traded with very minimal information in the world as a whole, and those platforms tend to have disappeared now. And we've always said we want to operate on a very transparent basis. What happens if we don't have the facts to be transparent today, but we might well have in a couple of days' time, in a week's time, a month's time? Then you have to pause trading. Otherwise, we're letting people trade without the proper information.
How are borrowers doing on repayments now in 2022 versus last year? Have you seen that get better, or is it the same?
It was pretty good last year, to be honest. I've seen lots of charts on our risk committee, monthly risk committee. That's one of dozens of data points that get tracked and carefully monitored and managed. And we've just seen a reduction in loans. For example, loans that went into forbearance loans that had difficulties and so on in the height of the pandemic. We've just seen that volume of loans that wasn't big to start with, but it was measurable. And we were very proactive on forbearance as well, which I'll cover off in a second. That basically the chart is just collapsing. All the numbers are heading into very sensible territory, and we do not have it's going down, not up. That's what I'm saying. It's not an increasing problem. It's a managed problem in the pandemic that is dissipating rapidly into very few loans with backlogs or difficulties. But of course, you still get defaults occasionally.
Occasionally, hopefully not too often, right? It happens.
If you weren't getting any, then I think we'd have to be paying our investors maybe 1 or 2% interest rate. That's the problem, because to get to pretty much no defaults, it's either a timing thing, a size of portfolio thing, how you manage things behind the scenes, perhaps, whatever, various financial engineering. But in the end, it all washes through. Mm-hmm. And I think we've always just wanted to give transparent data onto what we're doing, and I think we've got a history of talking straight on the whole in terms of what we've had to do, what we're seeing in the loan book, and what we forecast may well be happening, and trying to understand the economic situation and whether we think that's going to cause a problem.
Yeah, that makes sense. One of our viewers, Mike, says, and I think this is a great question, give me a brief overview of what your thoughts are on the future of the industry of peer-to-peer lending, since the FCA seems to view it as a high-risk form of investing now. I feel like they're putting it on the same level as cryptocurrency investing. What do you think about that?
Well, cryptocurrency speculation, yes. Cryptocurrency investing, I'm not sure the word's right. Okay. I used to say that 20 years ago. I used to say that buying something and hoping it goes up in price is speculation. Buying something for income with capital security is investment. And in that definition, it's fairly harsh. Stock market investment is really bordering on speculation unless you have a very broad portfolio or seriously sophisticated portfolio investment techniques. Crypto, I get crypto completely. I think I mentioned it on the last call completely. But it is speculation, really. It's the same as gold. Gold is speculation, really. There's nothing behind it at all. People are trying to put something behind it, but they're not doing a very good job of proving it to me anyway, and lots of others. So from our point of view, we are an investment. In my view, we've got, particularly our business with property security, we're absolutely an out-and-out investment, not a speculation. We delivered pretty much not a wobble. There was the smallest of wobbles, if you take a magnifying glass out, in the actual interest we paid in the access accounts in the pandemic. There was a wobble over a 2 or 3 month period of a minute fraction of a percent, I think it was. And that was it. And the security was there, the capital security is still there today. And so, with the benefit of hindsight and a long period of time to check it wasn't a glitch, we've delivered solid income with the smallest of wobbles in the pandemic and with capital security. And we've seen the stock market going up, down like a seesaw. The lucky ones who timed it perfectly did very well. Lots of other people probably did the usual trick of sell at the bottom.
Hey, don't talk about me. I've had that experience.
It is how it works, isn't it?
Yeah.
Whereas we're trying to deliver an environment where people don't need to buy, sell, trade this, trade that. We're trying to price the loans and build the provision funds and do all the various things that give people a smooth ride over the cycles. And there's one cycle behind us. And after we've done a few more cycles, maybe it becomes obvious eventually that we know what we're doing. But some people know already. Others are beginning to form the view. For others, it might take several cycles.
So, but what is your view on like the industry as a whole? I mean, we know Assetz is trying to do the right thing. We've had these failures.
It's a tough gig, isn't it? Really, because although it's taken time for the FCA to start enforcing some of the precise wording of its regulations with a number of platforms, it is now clearly doing it. We can see it in public domain now. And I've said for quite a long time that the last set of regs were perfectly sound enough. We don't need more than that, because just enforce that and everything's going to be fine. So I personally don't believe in further regs. I believe in further enforcement that the regs are being applied sensibly by the relevant platforms. But of course, that's making it, as the enforcement stroke holding people to account at the very least is increasing, that's basically making it harder and harder to set a platform up. It's getting more and more expensive to set one up with the regulatory setup costs. I mean, you're talking realistically to set a platform up with, well, software is a difficult one, because as I did suggest a long time ago, the whole idea of an appointed representative is an accident waiting to happen, in my view, because it's a very lightweight approach to looking after platforms that aren't regulated. So that's gone, it would appear, probably gone for good in this sector, which means people have to go for full regulation. So suddenly that is really expensive. You're talking about having to bring in software, regulatory knowledge, the business case to the FCA, who are now hyper nervous of new entrants and their capabilities and knowledge. I hate to think what it would cost to open a platform for business nowadays. Hate to think. £1 million cash is probably optimistic.
Yeah.
Very optimistic. And in the early days, people were doing it with small sums of money before the days of regulation. So I think it's tough in terms of investment. It's tough because the FCA is still going harder with its propositions and implementations of things. And I do think the industry is getting somewhat squashed, and I do not think it's fair that we've been lumped in with crypto at all. As I said, we're an investment, crypto is a speculation. Even though I understand it, and it has a place for some people in parts of their portfolio, quite potentially, it is just what it is. It's just another form of gold, isn't it? It's a different thing that has no intrinsic value, particularly. Admittedly, gold has slightly more because you can use it for something, but you know what I'm saying. Utility value of crypto is somewhat missing. So from my point of view, being lumped in together with crypto is very unfair. I can see where they're coming from, and I don't think it would have happened if a number of those past platforms hadn't exploded so spectacularly. I don't think we'd be in that box. And I think it would be reasonable to take us out of that box sooner rather than later.
Yeah, let's put the screws down on the FCA and see if they'll do that, Stuart. I'm gonna let's talk about C-bills. This has been a big part of your business over the last 18 months, 2 years. You've got this £1 billion funding partnership with Eros, capital partnership, and
over $1 billion,
yeah, it's a lot of money. So now this is, I'm presuming, going to fund the CBILS. Is that correct?
It was C-bills, but that came and went. That finished, and then we've applied for the RLS scheme. Took way longer than we thought because we were supposed to be grandfathered over, as everybody thought they would be, and it eventually took months and months for people. We weren't the last, thank goodness, nothing like it, but some people had to wait for a lifetime before they got approved for RLS. But no, this is a little bit RLS, but really it's just business as usual. Plenty of good cases out there, and this is business as usual lending mostly.
Okay, so you're using that to fund just standard retail lending. So I got to ask you,
standard lending to any normal borrower, because if it's applicable, which it almost certainly is, to either a retail source or a institutional source, we have a randomizer, goes through the cycle, goes to the relevant funder. So we don't pick and choose. You're not allowed to pick and choose.
Okay, so we've seen the big three close their doors to retail, obviously Funding Circle and Zopa, and I get asked this all the time about you being you're the next biggest right now. What's the commitment to continue, or are you still committed to continuing with retail peer-to-peer? Are you going to be taking that same path as, I'm presuming that could be considered quite a small part maybe compared to £1 billion of a funding line from Eros.
You say that, but it's a complicated mix. It's a funding mix. So what I mean by that is we've always wanted multiple legs on the stool, multiple funding sources coming into one marketplace. So this isn't about simplifying down to one funder, and Eros aren't the only funder either. We've got a number of institutions funding, about to be funding. We've got more like getting on for 200 million of funding, 2 billion, too many zeros, So we've got more like 2 billion of institutional funding, but it's not available tomorrow, next month in that sense. They're not looking to deploy it within 30 days. This is over the next year, 2-3 years, depending on the source. So a couple of billion or so is more than our current origination rate is running at, but that's fine because it lets us expand the business and invest into the business to grow into that funding supply. And that can only benefit retail. The bigger we get, the more origination we're doing, the more likely it is we're originating lots and lots of loans. So no, we do not have to suddenly devote every penny to our institutions. We have absolutely got a fair supply going to retail. And we've always said the same thing. If you go back over the years and look at all my quotes, it's always the same. So we will always give retail as much as they want. Admittedly, the pandemic broke the engine and we've had to rebuild it again, but that doesn't really count because that wasn't voluntary. That was a whole bunch of supply chain issues effectively that we're gradually working our way out of. But the principle is identical. It always has been the same. However much retail want, they can have, unless they suddenly give us, 100 million a month, 200 million a month of cash to invest. Growing from the current levels and going up 10, 15 million a month, 20, 25, as long as it's steady growth, then we'll just keep growing that part of the business. Right. And the more the better.
That's good to hear. That's good to hear because, it's becoming a case of where people inside the retail peer-to-peer sector are really struggling to find competent companies where they can feel comfortable investing their money through. So it's good to hear that you'll continue to support that sector of the retail side.
Read our, if they haven't read it already, and I think you mentioned it earlier, you might want to come back to it. The impact report, the Assetz.com website, so Assetz.com as opposed to Assetz Capital Co. UK. Assetz.com is our holding company, Topco site. That has the impact report on it. Have a read of it. If you've got any doubt about what we're trying to do and who we're trying to look after, have a read of the impact report. Retail investors are well and truly in there. We're looking to deliver income to people. And if people want our income, instead of putting it in a bank or putting it into funds or the stock market, that helps us grow that part of our business. If they don't want it, then we'll shrink it. And if it shrinks too far, we'd have to close it because it would be uneconomic.
Yeah, that makes sense. So again, if you want to read that report, and I have read through it, it's got a lot of interesting facts. You can go to Assetz, ASSETZ.com, and you'll see a button up on the right side. It says, let me show it on the screen, right here, Impact Report 2022, to see what Assetz Capital has been up to.
Well, is it us really? Or
Assetz, the company?
Do we just sense the mood? We sense the mood. People want income. People are fed up with the housing problems. People are fed up with the pension situation. People are fed up with people just profiteering, and the list goes on. And all we've done is build a business in Assetz that is a conduit for people to invest money to get a great return, but actually do some interesting things. We choose what we lend to, the type of markets we enter. And if you look at the stats, we're funded as a group, which predates Assetz Capital as part of the Assetz group. If you go back to the beginning, we've funded around 16,000 new homes in the last 20 or so years. 16,000 odd. About 5,000-6,000 of those are through Assetz Capital now. But 2.5 billion of new housing funded. 2.5 billion of new housing funded by Assetz companies. We've got 1.5 billion of that was just in Assetz Capital in the last 9 years. The income we've delivered to people, gross income, 170 million or so. We're materially moving the dial on SME house builders. 1 in 12 new homes from SME house builders. That represents, as a percent of the market, pretty much the entirety of growth in new housing coming into the market. And that's an important point because we don't think that taking a big percentage of the small house builder market that we're funding is not taking business from other people. We're part of the support bringing back the small house builder. The small house builder is what you want. If you don't want somebody building on greenfield fields outside your village, 200 new homes, then the small house builder is how you avoid that. Filling in the odd plot here and there, taking an old warehouse and putting 20 houses on it, or some apartments and so on. These infill sites, much more effective, already have infrastructure, more carbon neutral, frankly, and simpler to deal with. And that's the small house builder. That's who we support. That's who we champion. And these are all great things. We do a lot more with our supported living, working with charities, housing, people with various special needs, helping local authorities get the housing they need to put people into in their local authority areas. And it's an awful lot of things we're doing, but are we doing it? You know, we couldn't do a thing without our investors' money, could we?
Mm-hmm.
We choose the places where we think we can have a great impact as well as producing a great return. That's what the impact report is trying to highlight. We've not really explained it properly over the years, and gradually, if you look on one of the pages, page 7, just turn the UK map purple with pins that show things we've funded building, things we've funded people to hold, and with Assetz Exchange, things that we now own on behalf of our investors.
Talk to me about Assetz Exchange. We've had Peter Reed on here before, and I really enjoyed our chat. He seems like a very likable guy.
Yes.
How did that partnership come about?
Peter comes out with his brother out of Exchange trading software systems, and also out of the City of London as well, in stock market listing, IPO, brokerages, and so on. So he came out of financial services. Came out of a software world, building exchanges, which is where the word exchange comes from. We wondered whether we'd give it a different name one day, but we never have so far. One day we might change its name to something that's more to do with the output we give, rather than the fact that at the middle of Assetz Exchange's business is effectively a secondary market that acts like a property exchange. It's trading in loan parts, but it's effectively letting people trade in and out of an investment in a property. Effectively, that's exactly what it is, through loan parts. So it came about because Peter was up on the software side. He'd built a platform, substantial part of it, but where's the business model? Where's the property knowledge and all these other factors? So we effectively, in one way, gave Assetz Exchange an incubator environment to get set up. We took a stake in them. We gave them a lot of support and guidance, and the supported living, the provision of housing to charities and local authorities and housing associations, we gave them that idea. They started a little bit in buy-to-let, but buy-to-let is dead. Long live buy-to-let in its new form. And with all the tax impacts and all the other difficulties, apart from the speculation on house prices, buy-to-let is a tough gig nowadays and very hard. And it's not exactly flavour of the month, that's putting it mildly here in the UK. The government's after you from taxes. The people are after you because they think you're taking houses off first-time buyers, and it's a tough place to be in. To be honest, I can see where they're coming from. That was never our issue when we were involved in that market, because we delivered about 10,000 plus new homes. We were only involved in new homes, and so we were fine. But it's true, buy-to-let as a whole was all about buying up low-cost housing, and that's not going to help first-time buyers, is it? And it really isn't very good at all. So my old buy-to-let business, that was the first main business in the Assetz group, we sold that to management a while ago and exited it completely. And the reason was Assetz Exchange is the replacement for that. It's the new modern way of doing it. Let's fund the parts of the housing market in a sort of buy-to-let way, if you want to look at it that way, but let's provide housing to those with greater needs. Let's provide housing to the charities, to the local authorities. Let's look at supported living, people that need live-in care, people that are trying to get back into society from some form of institution. That's always a really difficult step, really difficult to find housing. When you come out of anything, it could be you were a child, you grew up in a learning difficulties support centre, but how do you go out into society and begin to live a normal life? How do you exit that institution? What happens if you're an ex-prisoner, first offender maybe? What happens if you can't find a house to live in? What's most likely to happen? If you haven't got a house with an address, hard to get a job. If you don't get a job, what are you going to do? You're going to go out to crime. So this is all about providing housing now for us that's targeting those very large, needy sectors of all forms of supported living. And there's an immense gap of about 50,000 beds here in the UK that needs filling. And that's before you even start talking about council houses, because that's another approach we could take. So there's just so many things Assetz Exchange can do. It's really barely started, but it's profitable, it's moving forwards, growing, and doing very well. And that's because it picked something good to do, and its investors are very, very happy and keen to fund what it does, and at greater and greater levels every month.
Paul New has asked, how profitable is Assetz Capital at the moment?
Yeah. So the last set of accounts we posted a few months ago were at about 2.3 million profit. We're not obsessive about profit consistently. I think that's our third profitable year out of the last few, but we're not obsessed with it because we also have to invest. And you can imagine, as I said earlier, if you have a couple of billion or so to lend out just from institutions, plus another probably $500 million or so from retail over the coming year or two at the most, then you have to grow your business. So we're investing like crazy in tech. We're growing the team. We've just got a lot of things we need to invest into. So this year will probably be a loss-making year again, bit of a seesaw, but that's all fine. It's part of the mix of a growing company. The underlying business is very solid, very margin creating, and I think I've always said it over the years. You know, I've been in business for so many years I can't remember immediately. Yeah, how many is it? 30 or is it 40? No, 40 years. Yeah, that'll be 40. No, it is. It's 40 years. So I've been in business 40 years, and I get all those dynamics, those financial dynamics. So what we are as a business, if you go back to about 2015, actually, in 2015, our gross economics pulled in plenty of money from our day-to-day trading that covers all the core overheads to run the business. But you have to then invest in growth for the future. Are you going to stay, like, for example, in the bridging market, are you going to stay niche with a few people, and you'll go off to a beach for a couple of years when each cycle hits, then you'll come back and do another load of years of trading? And are you going to remain titchy and make big profits, or are you trying to make a difference? We're trying to make a difference. So our equity shareholders want that, and they want us to build enterprise value. So that isn't purely about profits. Our top line margins are great, but then we choose to invest, sometimes a bit less than we produce in the year, sometimes more, mix in a little bit of equity investment, and they have a business that's growing to the scale it's growing, and off we go. And you know, we've got heading towards a £500 million loan book at the moment. We want the loan book for this business to be more like 5 to 10 billion within a few years' time. That means the active loan book, which you'll need to be feeding in, given we deal in short-term loans, feeding in a fair amount every year to keep that volume up, that loan book up and growing. And then you've got Assetz Exchange as well with its volume, and it's much more to do with holding property for a very long time. So its book will grow quicker, and maybe that grows somewhere between 10 and 100 billion over the next 10, 20, 30 years. These are the directions of travel we're going. So it's all about just making those numbers add up. But from our point of view, we've got a really profitable top line margin creation, not turnover, but margin creation. And we just choose each year how to invest that. And if you're going for growth, which at the moment with so much capital available is obviously what our partners want us to do, what our retail investors want us to do, and what we want to do, and our shareholder investors want us to do, then we'll put the foot down a bit, and we'll probably go negative for a bit, and vice versa. In the pandemic, the numbers were a bit different, and we made a profit. We made a profit a couple of years prior to that as well. So it's about growing the business sustainably, and we'll probably raise some more money this year because the opportunity is clear ahead of us. We're heading over time to be a new kind of institution. It's a fairer institution. It's more transparent. It's getting to scale, and we could be one of the top 2, 3, 4, 5 at the most non-bank lenders in the UK, supporting businesses and house building and so on. And that opportunity is clear. We're pretty much in that zone already. And the opportunity is to complete that journey, not let our shareholders down, and to do it carefully and sustainably, to not let the investors down either on the income side.
Okay, perfect. We've been going for about 55 minutes. I'm going to try my best to get you out of here in an hour because I know you've got a roast in the oven. Well, I don't know though. I'm just presuming.
Something like that. Yeah.
We'll go through a couple of questions that people have put into the chat. There's been a few questions, Stuart, about this loan queue, such as, I know you had mentioned that it should be cleared out by this month. You said, correct? Did I hear you say that correct?
There's currently about 17 million or so coming through this month. A bit of it will slip, I'm sure, but there's more coming through than we've got in the available cash in the cash account, in the access accounts. So we fully expect to start pulling money in from the queue pretty soon. I wouldn't be at all surprised if it was during the month.
Okay. Are you going to have functionality that would allow people to see what that queue amount is? I know this is something I think you've talked about in the past.
Yeah, I think when we get round to it, I mean, all these things have software overhead cost, and there's a lot of things we need to be working on, and limited resource. Now, how big you make the team, there's always limited resource. But yeah, visibility on the queue would make a lot of sense. We've said that for a while, but we just haven't done it. And I think we do need to do that, especially when it starts moving. Because when it wasn't moving, it wasn't so clear. It's coming, but it's not here yet. I think once it's moving, I do think I personally would prefer to have some kind of indicator that you've got. What have you got here? Have you got a 1 month wait, 2 month wait? I think a 1 week wait is less likely because we want to see some visibility on the money coming in. And if you go back to the beginning of the access accounts, we had good visibility on that queue. It was very sizable. And it gave us funding certainty. You don't really want to have to redo bits of paperwork and then give the loan to an institution, for example, if you were planning to do it on retail, if the money isn't there. So having a bit of a queue is all about sustainability, it's about stability, and it's about us knowing where the money's coming from. And if we do, we can allocate more loans into the retail side. If we're nervous of how much money the retail community has to invest with us, then we'll just divert more into institutional money. We don't want to do that, we've said that. So the more visibility we have on the queue, the better. But I think a nice, stable place to be would be plenty of money coming in each month and a queue that you work through that was maybe 30 days or so. But then once you're in, you're in. And there's no cash drag after that.
Okay. Me Too has asked, do you have an approximate amount of how much the refinances are being considered as the proportion of new loans? When you say new loans are coming in, are a lot of them refinances, or are they actually brand new lending?
No. There's always perfectly good reasons and a few bad reasons for why you'd refinance a loan. But no, we've never had a big number of refinance loans. What you do tend to get, though, as very healthy activity is when a developer has a development loan. We always build in a sales period, but they never want to commit to a hugely long sales period. So quite often they get left with a bit of stock at the end. That doesn't count. That's not an extension of a development loan, it's not like a bridge that you keep refinancing and the loan to value goes up and up and up and up and eventually it blows up. That isn't what this is. Development exit loans are probably the only thing that we proactively look to do. And that means if they reach the end of the sales period and they haven't sold it, we came to a middle ground on how long the sales period would be. They believe they'd be fully sold by that point, and if they're not, we offer them a development exit loan, and they repay in full the development loan and move on to a simpler developer type of bridge loan. It's basically a short-term loan where they quickly exit the remaining stock. So that's the type of activity that we would do, and that's very positive. That's very definitely something we want to be doing. Development exit loans are very common in the market, and it's a good way of just basically finishing off the old loan and putting it into a different nature of loan, because you're moving out of development risk period into the holding of some basic residential property in the UK, which is one of the lower risk things you could possibly do, really. Mm-hmm. And that's a good activity. But refinancing bridging loans, for example, which is the sort of thing that refinancing loans can talk about, yeah, we really aren't keen on that at all. And neither do we like refinancing somebody else's loan, because it's like pass the parcel. Yeah. Who ends up with the ticking bomb going off in the parcel? And that's what the bridging world is all about. and you don't want to be the last person carrying that parcel when the music stops. That is a very bad type of refinance, potentially, very risky. Generically, look at it very closely when refinancing a bridge. But for development exits, no, that's very healthy and very normal.
Stuart, so somebody had mentioned in the chat about a loan that had been repriced for quite considerably less than it was originally placed at. What is the thinking about when you refi something that you're offering lenders a smaller rate than they were used to getting on that loan?
So that might have been one of these development exits, possibly. I vaguely remember there might be a very specific loan, a one-off, but I don't know the details of it. So it's possible if what's referred to is, I can't imagine, because I don't think we normally would ever change the interest rate down on a loan normally at all. So that sounds a bit like a refi, but if it was an in specie refi, as in we left the same lenders in the loan, then it has to be the reduction of risk on the loan must have been fairly dramatic. Has to be.
So it gets repriced for risk, is that what you're saying?
Absolutely, because it was priced for risk. And if it was even if it was an in specie refinance, which I don't believe we do, but I think I've got a vague memory there was a case or maybe two cases where that was correct to do, then yeah, if the risk changes, the price changes. Mm-hmm. What do you
Yeah,
there's no way on earth it's gone down for the same risk.
Okay.
Our risk guys wouldn't let that happen.
Let's do one more question, and then I'll just give us we'll wrap up and let you get out of here. Let's see. So Mr. Heliums, I like that name. That's an interesting one. He says he's trying to find an argument for why he joined a 30-day queue or longer with Assetz when he could get the same rate through a different company with no cash drag.
Yeah, different companies, different risk. All the eggs in one basket if you go there. We like to think we've never asked, in fact I think we're in print saying so, we've never asked for everybody's money to come in here, whether it's everybody's money in peer-to-peer generally, everybody's money full stop. We just think we're a really sensible platform to have in the portfolio of your investments. So feel free to try other ones, but that's not an endorsement. And yeah, look very carefully. Our interest rates are solid. There's a number of people who offer higher rates who provided very, very good returns, consistent over the years. But it's just, what do you know? What's the track record? I think we've done a lot of good things over the years. We've been here now lending for 9 years, setting up the business for 10. But 9th anniversary was about now, give or take a day or two. And we know what we're doing. Safe pair of hands. And every return has to be balanced with risk. And if the interest rate is high, then there's some risk in there. You just may not know what it is. But that's always the case. That's the efficiency of markets. Markets aren't perfectly efficient. And I know all financial markets from my history in almost every asset class there is in investment. And I can tell you, when there's a high interest rate, I'll quote you something, forget the chap's name, but he's a very, very learned chap who's the banking correspondent for the US and Europe for the FT. And he did a very embarrassing thing. It's basically exactly what I'm talking about now. A very embarrassing thing a few weeks ago, quite a few weeks ago now, but not that many when I tell you what the story is. He was pointing out how cheap the Russian stock market was, and it was ridiculously good value, and the yields you were getting were 15%. I remember him quoting on such and such a company. I think he even identified some big companies offering 20% plus yields on the stock market in Russia. And this was approximately 10 days before the big button was pressed. So basically, even a fantastic chap, this chap is so learned, it's amazing. And even he put out in print, couldn't be retracted apart from groveling afterwards, something that said, look at this amazing opportunity to earn 15% plus in the Russian stock market. Even if you factor risks in, he said, surely it's worth it. And look where we are about 10 days after we published the article. And it's what I'm saying. High yield, I've said it for 20 years to investors, high yield tells you where risks are. You may not know what they are yet, but the reason it's high yield is lots of other people have a view. Sometimes it's fair to say they're wrong, and the high yield is mispricing. But usually high yield tells you where the risk is. You just don't know what it is yet.
So, Stuart, I have to ask you, because a lot of people in the chat are saying that they've seen loans that have gone from, say, 8% down to 5%, and the risk rating has increased.
Mm-hmm.
Do you know why that would occur?
Partially, yeah. Maybe we've changed our risk rating process, because in 2019, for example, there was a new risk rating process put in. So if you're looking at it over a number of years, that's one factor that would have definitely changed things to a degree. We've become more cautious. In the pandemic, we probably moved risk ratings up further because the uncertainty feeds into the overall risk calculations. And there's a whole multitude of reasons why, but interest rates going down, if you're talking more generically, if you're looking over the last 9 years, interest rates started at 14%, and we're now down at some loans in the sort of 6% zone, even the odd 5% one, but more normally higher than that. And it's basically reflective of the risk. But like I said at the beginning, lower interest rates do attract higher quality customers. But it doesn't necessarily mean our risk rating has gone down. It's a difficult thing because of the changing in the regs and the continuous caution we have. I do not think you can necessarily compare like with like. And also, we've just gone through 2 years of chaos, and we're probably being more cautious on the risk ratings than normal as well, because all those years of benign growth have ended, and we've now got much more visible uncertainty right in front of us, all sorts of types of uncertainty, and so I suspect it's pushed risks up.
One other thing I have to ask you before we go, because this is, I totally forgot to ask you, do you think that we know another platform is having an issue with their secondary market? Is this going to affect Assetz Capital's secondary market because of the FCA, do you think? Will this have some kind of run-on effect, or is this a single case?
No, it's the whole of the regs. They're so, in some ways, non-prescriptive. You could not write software. You couldn't give the regs to a programmer and ask them to write the software. And it's very, very hard to work through and come up with something that interprets the regs in a really fair way. Really hard work. And I've discussed this with other platforms in the years gone by when they were looking at implementing their own methods. And every platform does it differently. And if the FCA isn't clear about something, or somebody's implemented something in a way that wasn't agreed and then they find it out, the FCA, they start looking at it, ask you all the questions, see what your legal advice is, and then they don't necessarily take your legal advice if they really don't like the look of it. They then involve their lawyers, their barristers. Could you imagine having queries and probing questions coming out of barristers through the lawyers, through the FCA into you? That's a chain of events that really is quite painful. But we went through that process right back at the beginning of all the regs coming in, and we escalated up because we've given investors quite a smooth interface. We had that sort of challenge, and we went through the mill on that and popped out the other side, and everybody said, yeah, you know what, they're right. It's absolutely compliant. So we've been through that process. It's entirely possible. You can have a platform that's made some changes, hasn't done the forward notification to the FCA perhaps, maybe the FCA has found it, and then done a very deep dive as a result, because you're not supposed to do that. You're supposed to advise in advance. So that might be the case in some platforms, and who knows? And of course, goalposts move, regulations move, interpretation of regulations moves. There's nothing fixed in the world of regulated business. It's constantly evolving in the direction of protecting investors. So what you think might be okay one day might not be the next. But the FCA never signs off things very, very often at all. They did with our review, because they said, yeah, actually, you know what? There is nothing here of any interest. You've done it right. Goodbye. But what happens normally is the FCA lets you interpret. You need to make your own decisions, seek your own advice, decide if you're in the right place. So it can be very easy to fall into a place where you hope it's all okay. But you know what? When the FCA comes calling, it really isn't in their view. And they're not helping you. They don't sign you off. You have to make your own decisions.
Yeah.
So yeah, it can be tough out there, and it's expensive.
Yeah, that's one of the downsides. Well, look, Stu, I've definitely kept you a long time, and I appreciate you answering all the tough questions as best as you can. Anything else you want to say to the interwebs out there watching? Any new developments, anything exciting that you want to tell us about?
I think the last thing anybody wants is excitement. If you want excitement, go to crypto. But, investment
I already
should
did
be
that.
boring and profitable.
Okay.
So it's not so much excitement as we're just committed to keeping on going with the growth and deliver more and more of what you want and have a bigger and bigger impact so that you can earn a great return with us and have a great impact at the same time. So I'd just say read the impact report and see what your money is doing.
Yeah.
If you like what we're doing, give us more money. If you don't like what we're doing, go and invest it with somebody else.
I keep telling people that too. If you like what I'm doing, just give me more money. But it doesn't seem to work that way when I tell them that. But listen. I'll put that link of the impact report in the description, so everybody come back when the stream's ended, and you can find that. But thank you very much, Stuart. Very much appreciate your time.
No problem at all.
You're always very nice to come on.
Who's been watching? Thank you.
Yeah, absolutely. Don't forget assetscapital.com if you don't have .co.uk if you don't have a account. You can go to
Assetz Capital Co UK for the lending business. Assetz.com is the holding.
Got you. And we'll hopefully have you back on in future, get an update, see how everything's going. It's been wonderful. Thank you so much.
Thanks, Lawrence.
Talk to you soon. Okay. All right, Stuart.
Thanks, everybody.
Thanks.
Bye.
Okay, so there you have it, Mr. Stuart Law, answering those tough questions. I know, look, you cannot please everybody all the time, and it's the way it goes, but we try to get the answers the best we can from these people and trying to give you the best explanation. So I hope you enjoyed the stream. Please hit that thumbs up if you can and subscribe to the channel. If you're not a subscriber, it doesn't seem like much, but it makes a big difference to the way that YouTube treats the Financial Thing channel, especially after it was removed from the network, and it's been a tough slog getting that momentum back up. So if you can take that minute to do that and subscribe, I greatly appreciate that. You can also become a Patreon supporter down there. Point your mobile phone with its camera if you want, or look in the link below. We'll be back next Tuesday. Take a look at how much of a beating the Trading 212 account has taken this week. It's been a bit of a rough one. We'll talk about that on Tuesday. And thanks again for joining. Love every single one of you out there for the support. And I hope you're enjoying these Q&A sessions that we have with the peer-to-peer lending heads in charge. They're not easy to set up. These guys are very busy, and but I try to get them when I can for you to bring you that information. No one else is doing this out there. So I'm glad to be able to offer you that information and that value. So I will see you next Tuesday. Everybody have a great weekend. Stay dry out there. And that's it. Take care.